How are you? I hope you guys are doing well. I'm so sorry for the bit of a delay. Actually, the bad luck was on the peak for me. Actually, I just had this terrible backache. I mean, it's been uh, around 4 days, I guess, something. I have a terrible backache, and today, while coming back home, out of the blue, on the main road, my car's tire got punctured, and I was in no man's land. I'm not able to bend properly or something because of the backache and all, no? So that's why, I was trying. Then obviously I got some help from the auto driver. Basically, I stopped in and I requested him to change the tire. And then the poor guy, he helped me. And then I've been able to reach home and all, right? And then that's why I was just washing my hands and all. So that's why I just took a bit of a time. Anyhow, let's start. And as far as I remember, we are done with the conceptual framework and the asset class as well. And I remember we did happen to talk about the impairment as well, right? Kindly correct me. I guess we are done with the impairment as far as I remember. Is it so? Because I believe the impairment thing is done. And okay, here's what we have to start. Okay. Here we go. Okay, we are going to do some comprehensive practice from the exam kit. I've already extracted the questions which we are, going to use. And I have already shared the Google Drive link with you guys for the exam kit and for the book as well. So all you have to do is just go to the link and download the relevant material. And most probably I have given the notes over there as well. And if not, I'll share the notes, accounting standard notes and everything as well. The slides, they are shared. Yeah, I've already uploaded them on the portal. I'll look for the notes. If I haven't done, I'll share them onto the portal as well, right? And now, as you remember earlier, I told you guys about that this SBR when being compared with as far as the FR paper of the ACCA is concerned, it's totally different. It's totally different as in the sense the tables are totally turned over here. As in, over here, it's more about subjective. It's more about the explanation. It's more about, the way you express yourself and you write about the knowledge that you have, right? So over here, we have to practice a lot. I mean, as far as the expression is concerned, we have to correct our expression. Sometimes it's just that, we kind of get ourselves short of words. We know what we know about the standard or what the standards are related to, but we are unable to express, we are unable to explain ourselves, right? So obviously, with the help of the practice and all, we will be able to overcome this thing as well, right? So overall, the first question, I mean, this is from the December 18 attempt, and this is the exam kit question number 47. And then this is something I've extracted solely and explicitly from the conceptual framework and from the asset family, which we have covered so far. So we'll discuss about those questions today. Now, over here, the part A is Phil is a coal mining company and sells its coal on the spot and future markets, right? On the spot market, the commodity is traded for immediate delivery, and on the forward market, the commodity is traded for future delivery, right? And then, okay, let me just set, okay. The inventory is divided into the different grades of coal. One of the categories included in the inventories at 30th November 2026 is a coal with a low carbon content, which is of low quality. Phil will not process this coal, this low quality coal, until all of the other coal has been extracted from the mine, which is likely to be in 3 years' time. Okay. Based on the market information, Phil has calculated that the 3-year forecast price of the coal will be 20% lower than the current spot price. Okay. So Houston, we have a situation, multiple situations over here. At 30th November 2026, there is a low carbon content coal of low quality that is in inventory, right? And the company has decided it's not going to process this, and it will be processed at the end when they are done, and that is going to be in 3 years time, right? And then one more thing, that the 3-year forecast price of the coal will be 20% lower than the current spot price. Now, the directors of the field would like the advice on two matters. First matter was related to us, so that's why I've extracted it over here. Whether the conceptual framework affects the valuation of inventories. Now, it's asking whether the conceptual framework is going to affect the valuation of inventories or not. Now, overall speaking, when we have to talk about in such a situation where we have to discuss whether the conceptual framework, or we have to advise whether the conceptual framework affects the valuation of the inventories or not. So over here, what we have to do is the steps are going to be: step one, identify and explain the accounting standard involved, right? In step two, we are going to talk about what is the initial recognition and measurement criteria in the given standard, right? So we'll talk about that. What's the recognition criteria over here that's over there available in the given standard? Okay. Then we are going to talk about step three, related to the given scenario, and explain accordingly, right? So this is the basic step approach we need to have over here, right? I'll rewrite it in a while with the specific accounting standard, because over here we have to talk about the conceptual framework now. Now, obviously, as we read whether the conceptual framework affects the valuation of inventories now. So identify and explain the accounting standard involved. So technically speaking, we have the involvement of the conceptual framework over here. Then, as we are talking about the inventories over here now, so technically we have the involvement of IAS over here, so right? So we have two things that we have to talk about. So the best approach regarding this is going to be, we are going to start our conversation, we are going to start our discussion with the discussion of the conceptual framework. Like, for example, we can write that the conceptual framework provides us with the two measurement bases. One is the historical cost, and the other is current value method, that is NRV, right? As in international accounting standard, we have IAS 2, which provides the measurement criteria to account for inventory as well, right? So, therefore, the conceptual framework cannot intervene when it comes to valuation of inventory due to the presence of an accounting standard, right? As if there is any contradiction between the framework and the accounting standard, then the accounting standard will prevail, right? So basically, basically over here, it just asks us that either the conceptual framework is going to affect the, straight away, explained. We straight away explained that the conceptual framework obviously has the two methods to value the inventory, but already we have the IAS2 with us as well, right? So if we have the IAS2 over here with us as well, so technically speaking, the IAS2 is going to prevail over here because this is something we have already talked about. This is something we already discussed in the the conceptual frameworks when we were studying about the concept framework, that if there is a specific accounting standard in existence, then the accounting standard is going to prevail. The conceptual framework is not going to be over there, right? Because conceptual framework basically provides a skeleton based on the criteria on which although whole of the accounting, whole of the accounting is based upon. And in that accounting, the accounting standards are part of it, right? So this 4 or 5 lines for 4 mark requirement is more than enough. If you have seen, I've written the to the point answer over here. I've not gone into here and there the details, what the inventory is. I did not explain that what is the IS2, what it does deal with. I did not explain that what is the inventory according to the IS2 and all that, right? I kept a straight line where I created a balance between the conceptual framework. I straight at what the conceptual framework is and what is the rule, right? I mean, if I want to go for the fancy wording, I can start by explaining what the conceptual framework is, right? What the conceptual framework's assumption are, right? What are the elements of the conceptual framework are. I have gone for that as well. I mean, if you go or if you try to explore the answer within the exam kit for this question, you will see that there are lengthy answers written over there. Remember one thing, the answers in the answers on the ACCA Hub portal and a VPP or the capital exam kit, the real world situation, right? In an ideal world environment where the examiner is sitting, he has no pressure whatsoever and he has to cover from each and every aspect. Believe me, if you want me to, I can write it down on a piece of a paper as well. That if you are able to produce 30% of the answer, which is written over there in the exam kit, if you are able to produce the 30% of that, that's more than enough. I'm not saying by 30% that if, say, in case the answer is on 3 pages, then you just write the first page. No, I'm not saying 30% like this. I'm saying, say, in case this is the whole answer. Nah? From the first paragraph, extract the 30% relevant information. From the second paragraph, extract the 30% relevant. And from the third paragraph, extract the the relevant information that you have. That is more than enough, right? I mean, because if, believe me, we sit down and we have the whole answer in front of us, then believe me, in 3 hours, maybe we end up typing the whole, right? I mean, maybe will be taking like around 3 hours or so, even just to complete, just copy paste the answer to just see and then to write over here, right? So technically speaking, that is something like, the ideal situation. We are not into that. Over here, what you have to do is, if you are talking about the specific issue or something, if you are to the point, you are straight and you are explaining whatever is to be talked about, that's more than enough over here, right? Done. Now, let's just move forward. At 30th November 26, the directors of field estimate that a piece of mining equipment needs to be reconditioned every 2 years. Okay, so there is a mining equipment which needs to be reconditioned every year, every 2 years. They estimate that these costs will amount to 2 million for parts and 1 million for the labor costs of their own employees. Now, the directors are proposing to create a provision for the next accounting. The directors are proposing to create a provision for the next reconditioning, which is due in 2 years' time in 20x8, along with the essential maintenance cost. there is no legal obligation to maintain the mining equipment. Okay, there is no legal obligation to obtain the mining equipment over here. Right now, as explained above, it is expected that there will be future reductions in the selling prices of the coal, which will affect the forward contracts being signed over the next 2 years by the FIL. The director of the fair required advice on how to treat the reconditioning cost and whether the decline in the price of the coal is an impairment indicator. Now, if we now talk about over here, uh, we have, multiple, we have multiple issues on hand over here. When I talk about the multiple issues on hand over here, what do I mean? The issue over here, I mean, if we try to look over here, that is every 2 years you have to go into as far as the reconditioning, as far as the reconditioning of the equipment is concerned, right? And in the reconditioning, you will be incurring the cost related to as far as the parts is concerned, and then you will be incurring the cost related to as far as this the labor cost is concerned, right? So the point comes what to do with that. And then again, the directors have given a proposal that let's just go and take up a provision for the cost that you have to, incur after 2 years or so. And then also it's written over here that there is no legal obligation on the company. There is no legal obligation on the company to go and to have the, what do we say, as the maintenance and the taking care of as far as the mine and the surroundings are concerned, right? So this is the point over there as well. So what to do in in this context where we have this whole information over here, right? Now, overall speaking, if we talk about as far as the replacement cost is concerned for the part or the equipment over here, we can start off, by discussing as far as, okay, okay, let's just delete it out. Okay, we can talk about or we can discuss about the criteria of the cost of replacement of the component that we are going to incur. Now, we can start off that according to IAS 16, the capitalization criteria for a part replacement that we have. That is, I mean, if we talk about the new cost is capitalized, right? The new cost is capitalized and depreciated time period, right? So basically, the cost that you are going to incur and then the time period over which you are going to have its benefit and all, for that time period you are going to account for its benefit over here, right? Then the old part is de-recognized and resulting loss on disposal is accounted for in the statement of comprehensive income, right? Then if if it's a maintenance cost, then it is simply flushed in the income statement or the statement of comprehensive income as and when incurred in full, right? So we can talk about this over here in this way. Done. And then if we talk about the, overall speaking, if we relate to this scenario, we can simply say that the cost of major overhauling for the 3 million in total, which is going to be there, it is going to give access to the future economic benefits that we have, right? So, uh, overall speaking, if we talk about this one, we can relate it to the provision as well, right? Now, the directors have proposed that we can go for the provision over here, right? Now, as far as the provision is concerned, we can simply say that the directors proposal to create a provision is not valid over here, as there is no legal obligation to create a provision, right? There is no legal obligation to create a, to create a provision over here, right? And there is no apparent constructive obligation, and there is no constructive obligation as well. There is no apparent constructive obligation as well, right? Then, overall speaking, the cost of reconditioning, if we talk about, right? This is the cost that we are going to incur, then its benefit is over there in the future as well, right? This reconditioning cost has nothing to do what we have done in the past, right? I mean, it's not related to the past activities. This is going to be related to the future activities, right? So that is why we cannot create the provision for that as well, right? So we cannot create a provision for that as well, because the provision has to be created, or the provision basically arises, or provision is a liability of uncertain timing and amount, and for the liability it has to arise from the past event. There's no such a past event over here, so that is why we cannot go over there, right? Now, overall speaking, the question also asks, the directors of fail require advice on how to treat the reconditioning cost and whether the decline in the price of a coal is an impairment indicator. Now, over here, we straight away have the IAS 36 over here as well, right? Now, if we go with the impairment over here, we can simply say that the IAS 36 states that at the end of each reporting period, the entity has to, assess whether there's an indication which leads that the asset might be impaired or something, right? And then we have some external indicators, we have some internal indicators as well. We can talk about this as well, right? Like, for example, we can write about this that IAS 36 states that an asset should be assessed for an impairment if there are certain indicators available indicating towards its impairment. There are external and internal indicators. There are external and internal indicators which should be assessed at each reporting date regarding the impairment of assets, right? Now, we can talk about, or we can also give the examples of internal and external indicators over here as well, right? So we can give the example of internal and external indicators over here as well, right? Then, if we try to, relate it with the scenario over here, we can say that the carrying amount, if it exceeds the recoverable amount of the mining, then there is going to be an impairment. And the nature of the mining assets, I mean, if we talk about, they normally have a long life. Commodity prices, they can be volatile, but obviously the downward movement of the prices is an indicator. The downward the downward trend in the prices, basically this is an indicator that the mining itself or the asset over here might be impaired, right? Because this is an indication that if the forward prices are going down, or overall over here if the prices are down, this is an indication that yes, the asset has been impaired or something, right? So technically, if the prices or the forward contracts for the next 3 years, the prices are going to go down by 20% than the current spot price or something, right? Then yes, this is an indicator that the asset has been impaired, right? But again, if it's a short-term fluctuation, right? If it's a short-term fluctuation, then in that case, or it's expected that the prices are going to go up or they're going to come back to the actual price, right? Or the higher actual level, then yes, we can say, or then we have to assess more that, it might be possible that the asset is not impaired and it's a temporary fluctuation that we are looking. Like for example, if you guys remember in the COVID, when the whole world shut down, when the whole world was on a full stop, if you remember at that time, the crude oil, its prices went down like anything. And at the same time, during that time period, the Iran had a sanction, it had a ban to export its crude oil and all that. So the ban was ended at that time as well. So Iran started to have its crude oil in the market as well. So technically the demand was already low. And then at that time, the extra inventory came in the market. Supply was over there on the higher side, so the value started to go down historically, speaking. I mean, if we try to look back and assess, right? So the prices were going down, but that was a temporary, the slump in the prices. And then gradually the market stabilized. And then the gradually, the crude prices or the crude oil prices, they started to go up again, in the market. So if this is the trend over here, I mean, I'm just giving the example over here just to make you guys understand that if it's a temporary, slump, then this is something which can be recovered and this can go up as well, right? So this is what we have over here. I mean, we can talk about from the impairment point of view as well. I mean, we can talk about the external and internal indicators, and we can say over here that the indication of the price or the forward prices in the market, which are going to be 20% down, they indicate yes, the asset has been impaired. But if this decrease in prices is temporary or something, right? If the decrease in the price is temporary, then it might not indicate that it's an impairment. And if it's expected that the prices are going to go up in the future, then there's no point of charging the impairment or something, right? So we can explain like this as well, right? Okay. Then we have this question 55 over here. This is the white book question. And this white book question, if we talk about, this is meets the definition of the small entity in its jurisdiction and complies with the IFRS for the SMEs, right? And small medium enterprises, and Whitebook has entered into the following transactions during the year. Point number one, point number two, then required. In accordance with IAS 23 borrowing costs and IAS 38 intangible assets, advise the directors of the White Book on how the borrowing cost, Note 1, and the research expenditure and development expenditure in Note 2 would be accounted for in the year ended 31st May 2026. Right? You just guys read it for a second. I'm just coming and then we are resuming. Okay, just read it for the second in which I'm just coming back. Okay. Point number one is Whiteberg requires a new machine which will be included as a part of its property, plant, and equipment. Whiteberg therefore commenced the construction of the machine on 1st February 2006, and this continued until this completion, which was after the year end of 31st May 2006. The direct costs were 2 million in February 2016 and then 1 million in each subsequent month until the year end. Whiteberg has incurred the finance costs and general borrowings during the period, which could have been avoided if the machine had not been constructed. Okay, so you had to incur the finance cost, which technically could have been avoided if you had not constructed the machine. Whiteberg has calculated that the weighted average cost of borrowing for the period from 1st February to 31st May on an annualized basis amounted to 9% per annum. So for the point one, we have to talk about that in accordance with IAS 23 and IAS 38 intangible assets, advise the directors on Whiteberg on how the borrowing cost in note 1 should be assessed. Now, overall speaking, again, you know, if I talk about the approach over here, so the same thing is we have to talk about what the scenario is related to. What is the accounting standard to be discussed? Over here, obviously, we have the IAS 23, the borrowing cost about which we have to talk about, right? So we are just going to tell that what the borrowing cost is and what the standard has to say, what is the initial recognition criteria, and then, take up the problem one by one and address those while like, relating it to the scenario and all is concerned, right? So we can say we had these steps with us, these steps, right? So I am going to copy these up. Again, I'm just copying this approach over here, right? Okay. Then IAS 23 borrowing cost require an interest to be capitalized when a qualifying asset takes a substantial time to complete or acquire and the interest cost is incurred for the construction or acquisition of such asset, right? And then accounting standard involved, right? And then the initial recognition criteria. I mean, we can like talk it about over here that the borrowing cost includes the interest expense calculated by the effective interest method, right? Or on a specific interest rate where all the money borrowed is from one source, right? So either you take up the effective one or you go for the one interest rate from the specific loan that you have. Okay, now the finance charge on lease, exchange difference arising from foreign currency borrowed to acquire or construct the asset are also included, right? Done. Now then we can say that the capitalization of the borrowing cost start when the active work to acquire or constructing the asset starts, right? And then it ceases to capitalize when the asset is available for use. right? Done. Then the weighted average cost, right? The weighted average cost, if we talk about overall speaking, you know, if we see over here, annualized basis 9%, and then we have taken 2 million on the 1st February, right? And then 1 million each of the subsequent month, na? So February, March, April, May. February, March, April, May. Yani 1 million each month, right? So over here we can have the weighted average cost or carrying value of the loan for the machine till the year end is, we had 2 million in start, then it increased by 3 million, oh sorry, 1 million each of the month, nah? So if increased by 1 million, it became 3 million, then 4 million, and then 5 million over here, right? And then divided by 1, 2, 3, 4, 4 months over here, right? So that's gonna be on average 3.5 million, the weighted average cost of borrowing, right? And the weighted average cost of borrowing is 9%. So the cost of borrowing that should be capitalized for the year ended, what's the year end? 31st May. For 31st May 20x6 will be, we have 3.5 million into 9% into 4 by 12. So what do we get? Let me get the calculator. So we have 3.5 million multiplied by 9 multiplied by 4 by 12. I have 105,000. 105,000 or 0.15 million, right? So this is the cost that I should capitalize in case or in the context of as far as the borrowing cost is concerned, right? Okay. Now let's just move forward. Borrowing cost is done. And then we have point number 2. Whitebug has incurred 1 million of the research expenditure to develop a new product for the year ended 31st May 2026. Additionally, it incurred 0.5 million of development expenditure to bring another product to a stage where it is ready to be marketed and sold. Okay, so we have spent 1 million on the research, and then we have incurred 0.5 million on the development of new product to bring it to the stage where it is marketed and sold. Okay. Now we can talk about this number 2 over here, that according to IAS 38, the research is a planned investigation so as to get a competitive advantage in the market. The outcome of research is not clear. That's why all the cost incurred in the name of research is expensed out in income statement as and when incurred. But the tools, equipment, infrastructure used for research is tangible non-current asset. It will be capitalized and depreciated accordingly, right? So it will be capitalized and depreciated accordingly. Now, what's the name? White brick, white book. White book has incurred 1 million in the name of research of a product, right? And to develop a new product, now, right? So we can simply say that the 1 million in the name of research, which we have incurred, it should be or it will be expensed in the income statement for the year ended 31st May 26. On the 31st May 26. Done? Now, we are done with as far as the, research part is concerned. Then we'll say development is bringing the research into reality. IAS 38 allows you to capitalize the development is bringing the research into reality. The IAS 38 allows the development cost to be capitalized if a certain criteria is met in full. Done? Now, so the criteria is sector, that is separate project, expenditure identifiable and measured reliably, commercially viable, technically feasible, overall profitable, resources available to complete. So we have this sector with us, right? These are the recognition criteria that we have. I mean, this criteria, has to be met, if we want to capitalize the development cost, right? Now, if any of these point is not met, then IAS 38 doesn't allow the development cost to be capitalized, right? The development cost, once written off in income statement, can never ever be reversed. And then the development cost incurred 0.5 million, right? Okay, so the development cost incurred by Whiteberg. Yeah, Whiteberg. of 0.5 million will be capitalized as this cost has been incurred so as to bring the product at a stage where it is ready to be marketed and sold. Right? Okay. Now, once the commercial production starts, the capitalized development cost will be amortized over the useful life of the project. Right? So this is what we have overall speaking as far as related to this, whole question is concerned. And now what we have written, it's more than enough overall speaking as far as for the 23 and the IAS 38 is concerned, right? I hope it's clear. If you have any question or something regarding this, you can ask me. Otherwise, we are good to go. Okay. Now, second part is discuss how the two transactions should be dealt with under the SME standard in the year ended 31st May 2026. SME is a small medium price enterprise standards, right? We have to still talk about this one over here. And overall speaking, as far as for the SME is concerned, obviously the borrowing costs are always expense to the statement of profit or loss over there, right? Therefore, none of the borrowing costs incurred as a result of the construction of the machine can be capitalized. Then, as far as the SME for the research and development is concerned, the entity is going to recognize the expense incurred on an internally, overall speaking, on an intangible item is concerned, including the expenditure on both the research and development as well, right? So the expense of 1 million for the research and 0.5 million for the development, they are going to be charged to the profit and loss as well, right? Now we have to talk about the SME standard. I've just given you the fast forward that what is dealt over there, right? So we have to talk about to the point over here regarding the SME over here, and we'll be done for the 4 marks. Okay. So that is the approach. Basically, we have to set over here according to the SME over here as well, right? I mean, if you want to write it down over here, you can. Okay, let me just do it for you. Like we can go for the part B over here, and we can simply state over here that in accordance with SME's standards, borrowing costs are always expensed out, right? In the statement of comprehensive income as and when incurred, right? Therefore, none of the borrowing cost incurred by the white book will be capitalized. And then we are going to say for research and development, the SME's standards are clear that any cost incurred on internally generated intangible assets will be expensed out as and when incurred, and it cannot be capitalized, be it research, or even the development. Therefore, this total cost of 1.5 million incurred will be expensed out as well, right? So we are going to expense it out as well. Done? I hope it's clear, right? So this is the whole answer that you have to construct over here for this one. And this is going to be, you know, more than enough over here. I have talked about each and everything. I did not left anything behind related to the specifically talking about as far as the standard is concerned, right? So this is the approach that you need to set over here, right? Okay, we have now over here of the skizzer over here, right? But while in maximum 5 minutes, I'm going to come back and then we'll talk about the skizzer question over here, right? Let's have a break. Okay, I'm back. So let's assume now. Now we have this Skizzers question. This is again from the exam kit, right? So let's see, what do we have? Skizzer is a pharmaceutical company which develops new products with other pharmaceutical companies that have the appropriate production facilities. Stakes in the development projects. When Skizzer acquires a stake in a development project, it makes an initial payment to the other pharmaceutical company. It then makes a series of further stage payments until the product development is complete, and it has been approved by authorities. In the financial statements for the year ended 31st August 2027, Skizzer intangible assets because Skizzer's ownership of the products right. However, in the year ended 31st August 2028, the directors of Skizzer decided that all such intangible assets, research and development. I'm sorry, I got disconnected. Okay. So the directors of Skizzer decided that all such intangible assets were to be expensed as research and development costs, as they were unsure as to whether the payment should have been initially recognized as intangible assets. This write-off was to be treated as a change in accounting estimate. Okay. Now, overall speaking, again, if we talk about this question, again, we have that same very, the three-step approach that we have earlier. This one. We can talk about this same stage approach over here. And overall speaking, we can say IAS 38, intangible assets. For intangible assets to be recognized in the accounts, the add-on criteria is that it has to be identified, right? Means it should have the capability of being separated and sold independently from the organization, right? Now, if the criteria for recognition is not met, then intangible asset cannot be recognized and it should be expensed out in the income statement, right? So this is what basically, we have the whole thing over here. Now, for intangible asset, obviously it has to be identifiable. It should have the capability of being separated and sold from the organization independently as well. If the criteria is met, then yes, it's going to be capitalized. Otherwise, we straight away go it's expense out, right? Then for research and development, IAS 38 clearly states about the recognition criteria, right? Okay. Let's just fix it up. Now, for research and development, IAS 38 clearly it's not started. For research and development, IAS 38 clearly states about the recognition criteria, right? And I mean, we can write it up over here that all research cost is expensed out as and when incurred as the outcome is not clear. For development to be capitalized, a certain criteria in full has to be met. If the criteria is met in full, then we capitalize the development cost, else all the development cost will be written off in the income statement. Right now, let's just state it with the scenario that we have at hand. Okay. Now, the directors, what they did, first they capitalized and now they are expensing it out and stating that's a change in accounting estimate. Directors of SCSR are unsure if the payment made for research or development should be capitalized or not. They simply should see if the amount that they were paying was related to research. I mean, they should simply say that if the amount they were paying was for research or they were paying for developing the product, right? If it was research, then it should be expensed out, right? If it was development, then if it meets the recognition criteria, then it should be capitalized or it will be expensed out as well, right? Capitalized and then simply. Okay. So if it meets the capitalization criteria, otherwise, if it meets the criteria, then it will be capitalized or else it will be expensed out, right? But simply saying that it's a change in accounting estimate, it's wrong because the accounting treatment of research and development cost is clearly stated in IAS 38 and it has nothing to do with IAS 8, right? So straight away, we are going to, talk about this over here, right? Done? And okay. Yeah, so we have this over here, right, for this. Okay, now moving ahead from here, this is all done. Now, sale of development we have over here, right? Okay, we have to talk about outline the criteria. No, we just talked about this one over here, no? Yeah. So they were like, not sure about that, so that's why we just had it over here. And we have outlined the criteria in the IAS 38 for the recognition of the intangible assets and discuss whether these are consistent with the conceptual framework. Okay, we have to talk about the linkage of the conceptual framework over here as well. Okay. For the linkage of the conceptual framework, we can simply say that the recognition criteria is met for capitalization, right? Let's assume if the recognition criteria is being met, then what? Relate it to the recognition criteria as mentioned in IAS 38 regarding the research and development. Right? If you have doubts about the recoverability of an amount, then IAS 36 is applied and the intangible is checked for impairment, right? And then again, let's just have it over here and this one over here. IAS 8 cannot be applied, right? As the change in accounting estimate is the change in the carrying value of a non-current asset from which you expect to have a future economic benefit, right? So if we talk about as far as the conceptual framework is concerned, now this is the straight away, we have the recommendations over here, right? Now, overall, this is the point where we said if the recognition criteria is met. Now, if say in case recognition criteria is not met. If recognition criteria is not met, then what to do? We can relate it that if 𝐁𝐭𝐫 believes that recognition criteria is not met, then it has been approved in the financial statements of the 20x7 as well, nah? Okay, and then we have the other year end as well. So over here, first we made the payments, and then in the 31st August, we had the doubts over here, right? So if the recognition criteria is not met, then in 20x7, the capitalization of development cost is wrong application of an accounting standard, right? Therefore, the correction should be retrospective. Now, we have read the IAS 8 as well, nah? One is the change in accounting policy, one is the change in accounting estimate, and if you have applied wrongly as far as the interpretation of the accounting standard is concerned, then you have to adjust the previous year accounts as well, right? That is, the change has to be accounted for in the retained earnings of or for the previous year. For the previous year and in the income statement for the current year as well, right? So in 20x7, how much of the skills is spent? I cannot see the any amount, right? Okay, done. There's no amount, so we can just simply write it in a general way. In 27, any amount spent on research and development, right? So any amount is spent on on the research and development will have an adjusting or rectifying entry with the opening retained earnings balance, right? So in 27x7, if you have spent any amount, that's going to have a like retrospective change over here. Done. Then the sale of development project is now what we have over here. The sale is on 1st September 26. Skizzer acquired a development project as a part of the business combination and correctly recognized the project as an intangible asset. However, in the financial statements of 31st August 2027, Skizzer recognized an impairment loss for the full amount of the intangible asset because of the uncertainty surrounding the completion of the project. Okay. During the year ended 31st August 2028, the directors of Skizzer judged that it could not complete the project on its own and could not find a suitable entity to jointly develop it. Thus, Skizzer decided to sell the project, including all rights to the future development. Skizzer succeeded in selling the project, and as the project had a nil carrying value, it is treated as a sale proceeds as revenue in the financial statements. The directors of the Skizzer argued that IFRS 15 revenue from the contracts with the customers states that the revenue should be recognized when the control is passed at a point in time. Okay. Now, this point is something, for which we have to talk about as far as the revenue is concerned as well, right? So I'll be talking about this part over here, but I will be talking about this part over here in a summarized form because obviously we are going to, or we will be talking about this revenue standard over here as well, right? So once we do that, we'll again obviously discuss about this question again. But overall speaking, for now, what we can do is we can talk about this one in a general way, right? Now, IFRS 15, I mean, if we talk about as far as the revenue from the contracts is concerned, it basically deals with the income arising from the company's ordinary course of activities, right? Now, over here in the whole question, I've not seen anywhere which indicates to me that the Skizzer's business model is to sell the development projects. I have not seen that, right? Or normally speaking, the Skizzer's business model is to jointly develop a product, then leave the production to the partners. This is what I've read over there, right? And then again, I mean, if we talk about this over here, the asset, if it's in the is for sale in the ordinary course of the business, then obviously it's going to be classified, as an acquisition of the inventory. Then there's no point of capitalizing the development cost at all, right? As a Skizzer has accounted it as an intangible asset, right? Or a fully impaired asset or something, right? Because it has been impaired now, because you are unable to judge either you are going to complete it or not, or you will have it or not, right? So it can't be argued that it's like, thereafter treated as a held for sale in the ordinary course of a business or something, right? Therefore, I mean, simply speaking, it cannot be regarded as a sale or in the normal course of a business. And then secondly speaking, IAS 38 also prohibits, like, presenting the proceeds of any disposal of an intangible asset as a revenue, right? So the director's opinion stating, that it should be accounted for over here as a sale or something, it cannot be done. It cannot be done over here, right? And then it says over here, discuss the implication for the SCIS's financial statement for the both years ended 31st August and X7 and X8 if the recognition criterion IAS 38 for an intangible asset were met as regards the stake in the development projects above. Okay. So met or not met is something we have already talked about. And then the third point is discuss whether the proceeds of the sale of the development project above should be treated as a revenue. Now, so we are talking about this point over here now as a revenue. So we have already talked about that this is something which cannot be accounted for, at least as a revenue is concerned, right? Because this is technically speaking something, not met over here, right? So it cannot be met over here as a, like, the sale and all and everything is concerned, right? Okay. So this is what we have for now. Now, let me just copy up another question and then we'll resume more. Okay, do we have another question over here? No, no, we don't. Okay, let me just copy another question and then we are moving it. Okay, just give me 2 minutes only. Okay, let's just talk about this question as well. Format has a subsidiary key which has a significant amount of non-current assets. There are specific assets on which the directors of key wish to seek advice. Number one, key holds non-current assets which cost 3 million on 1st June 2023 and are depreciated on straight line basis over their useful life of 5 years. An impairment review was carried out on 31st May 2024 and the projected cash flows relating to the assets were 280, 450, 500 and 550. The company used a discount rate of 5%. Then at 30th November 2024, the directors used the same cash flow projections and noticed that the resultant value in use was above the carrying amount of the assets and wished to reverse any impairment loss calculated at 31st May 2024. The government has indicated that it may compensate the company for any loss in value of the assets up to 20% of the impairment loss. Okay, so this is an indication from the government that it might or it may compensate for the losses. Okay, now point number two. Key holds a non-current asset which was purchased for 10 million on 1st December 2012 when an expected useful life of 10 years. Then on 1st December 2023, it was revalued to 8.8 million. Then on 30th November, the asset was reviewed for impairment and the written down to its recoverable amount of 5.5 million. Now, discuss with suitable computations in reference to the principles of the relevant IFRSs how to account for any potential impairment of the above non-current assets in Key's individual statements or financial statements for the year ended 31st November 2024. Now, look over here at this point, which is really, this discuss suitable computation with reference to the principles of relevant IFRS. So it means reference to the principles that we have to talk about what's over there in the standard, right? Okay. So if we have to talk about the standard, what we can do is we can start. Oops. Okay. Now, again, three-step approach, the same. We can start by saying that the basic principle of IAS 36 impairment of assets is to report the asset at no more than its recoverable amount. Now, the recoverable amount is the higher of value in use or net disposal proceeds. If an asset's carrying value exceeds its recoverable amount, an impairment loss has occurred. Right? Now, the impairment loss has to be recognized. Yeah. The impairment loss has to be recognized in the income statement in the same year in which it arises, unless it reverses any revaluation gain made on the asset in the past. So over here, I just gave the overall view of how the impairment has to be accounted for. Right now, we just talked about the assets recoverable amount, that when the carrying value exceeds the recoverable amount, that's going to be called as the impairment. Now, an asset's recoverable amount is the higher of the fair value less cost to sell. This is the price that would be received to sell the asset in the orderly transaction between the market participants at the measurement date under the conditions or under the conditions which are favorable to both the seller and the buyer, right? And the disposal costs will be netted off from the proceeds, if any. Right? Okay. Then Second point is, this is the fair value less cost to sell, na? The assets value in use. It is the present value of future cash flows generated by the asset, including its estimated disposal value at the end of its useful life. Time value of money has to be considered while calculating, while calculating the value in use and the future cash flows. No, wait. Time value money has to be considered while calculating the value in use and the future cash flows of the company. The future cash flows of the companies have to be determined via discount rate according to company's required rate of return. Right? Now, this is the recoverable amount. Done. If we go up, projected cash flows are over here, right? So cost is 3 million over here, right? Okay. And the discount rate is 5%, nah? So what we can do over here is we can also write about it that as the future cash flows are estimated at the end of the year at 31st May 2024. Therefore, in order to compare the carrying value has to be not estimated, it has to be calculated. Yeah. It has to be calculated at this date as well. So the carrying value at 31st May 2024 is going to be, the cost is 3 million, the life is 5 years, and we are at the end of first year. Okay. So 3 million by what, 4? No, sorry, 5 years life. So 3 million by 5, what do we get? 600,000. Depreciation charge. So the carrying value is 3 million minus 0.6 million is 2.4 million, right? Now, this needs to be compared with the recoverable amount at the same date, right? So now, if we have the recoverable amount and all, na, so what we are going to do is we can calculate the present value. Yeah. We can calculate, overall speaking, as far as the present value of the asset is concerned, right? And if we want to, we can insert a table as well. So we have number of years, cash flows, discount rate, present value. Yeah, four columns. So let's just have 4 columns over here. So we have year, we have cash flow, we have discount rate, and then we have present value as well. First year is ending on 31st May 20x5, right? Okay, let me just copy this for a second. Let me just paste it here. Okay. So in 20x5, I have cash flow of 280. In 20x6, I have cash flow 450. In 20x7, I have cash flow of 500. And then in 20x8, I have cash flow of 550. So 280, 450, 500, 550. Done. Now, as far as the discount rate is concerned, this is 5%, and I've been provided with these discount rates, right? So I'll go over here, paste. Done. Now, the present value. So 280 into 0.9524. I get 266.67, or rounded off to 267. Right? Then 450 into 0.9070, 480. No, sorry, 408. Then 500 into 0.8638. I get 431.9, that's 432. And then 588,227, that's going to be 452. Done. Now, we have total present value of 267 plus 408 plus 432 plus 452. 1559. Right? Now, this is the recoverable amount, 1559. This is the carrying value. So, when the carrying value of an asset exceeds its recoverable amount, Houston, we have an impairment. So carrying value 2400,000 is greater than the recoverable amount of 1559,123. So the impairment is 841,000, right? So that is the impairment that we have over here. Okay, reference to relevant or how to calculate any potential impairment. So we have accounted for any potential impairment that we have over here, right? Now, overall speaking, we have this point over here. The government has indicated that it may compensate the company for any loss of the assets up to the 20% of the impairment loss. Okay. Now, let's just talk about this thing over here as well. The frequency. Let's just talk about the impairment thing, The frequency of checking the impairment or reversal of impairment is normally done at the year end, right? Therefore, reversal in the middle of the year will not be accounted for, right? This one. The key holds a non-current asset which was purchased for 10 million, huh? So we technically, on the 1st December, it was revalued to 8.8. Okay, on the December 1st, they are in between, huh? So what we have to do is, if we talk about as far as for the impairment is concerned, the reversal is not accounted for in the middle of the year. So we have to check the impairment, obviously, at the end of the year. Then the compensation from the government. The compensation receivable from the government will be treated according to the rules of if it's the compensation and if it's the compensation that we might receive if the asset has suffered any impairment or something We can go for IAS 37, provisions, contingent liabilities, and contingent assets, right? Now, the contingent asset, if we talk about, is only recognized when it is virtually certain that the amount will be received. In this case, it says the government has indicated it may compensate, right? In this case, the government has indicated that it may pay for the compensation, right? Therefore, this may, or I mean, we cannot write like this, that this may. Therefore, this compensation is not virtually certain as it is not properly indicated by the government that it will pay, right? Therefore, no compensation, will be accounted for over here for this loss, right? I hope it's clear. That now, the second point is where he holds a non-current asset which was purchased for 10 million on 1st December 2021 with an expected useful life of 10 years. And then on 1st December, it was revalued to 8.8 million. And then, okay, let's just have it over here. Okay. This is the second requirement that we have. Now, as far as for the revaluation is concerned, revaluation, oops, spelling it wrong. I'm not good at typing. Now, for the revaluation of asset, the following treatment will be done. First thing first, when the revaluation is done on 1st December now, so we have to calculate the carrying value of the asset at 30th November 23, because 1st December or 30th November 1 is the same thing, right? At the year end, because it's happening at the start, right? So the amount is 10 million, right? Minus 10 million divided by the life is 10 years into, we got the asset on 20x1 now it's 20x3. So 2 years have gone by, right? So we are going to have what? 10 by 10 into 2 is 2. So 10 minus 8 is 2. So that is 8 million. Right? Now, fair value 8.8 million. Carrying value 8 million. So revaluation gain is 0.8 million. Now, revised carrying value at 30th November 20x3 at 8.8 million, and remaining useful life is 8 years, right? So carrying value at 30th November 20x4 will be depreciation charge for the year, that is revalued amount divided by remaining useful life, right? So here that's going to be 8.8 million by 8 years, right? Then that's going to be what? 8.8 by 8 is 1.1, yeah. Depreciation charge, right? So the carrying value will be 8.8 million minus 1.1 million. That's going to be 7.7 million. Right? Now, over here at 30th November, we have this 7.7 million over here. Now, if we look over here at 30th November, the asset is reviewed for impairment, and now the recoverable amount is 5.5 million, right? Now, this is the carrying value. Sorry, the carrying value. Now, the recoverable amount at the same date is 5.5 million, right? So, impairment losses carrying value minus, sorry, impairment losses when the carrying value is exceeding the recoverable amount. Now, the carrying value is 7.7 million. Recoverable amount 5.5. Done. So, impairment loss is 2.2 million. Done. Okay. Just give me 2 minutes. We are resuming. Just 2 minutes only. Okay, I'm back. Let's resume. So I was talking about we have the impairment loss of 2.2 million over here, right? Now, okay. Yeah, it's for 2.2 million. Now, overall speaking, as we have this impairment loss over here now, this impairment loss will be charged against the revaluation reserve, and then if any balance remains, then it will be charged in the statement of comprehensive income, right? For the same year. The following entries will be made. Debit revaluation reserve. Okay, revaluation reserve. How much of the revaluation reserve did we have? Revaluation is 0.8 million. So we are going to, okay, let's just go to the next page. So we have revaluation reserve 0.8 million, right? We are going to debit the balancing amount of the statement of comprehensive income as an impairment. And that's what? Okay, we are not on the second page. Okay. Now, total impairment loss is 2.2 million, nah? So what's the balance remaining? 2.2 minus 0.8. 1.4. So 1.4 million over here. And then credit the asset with 2.2 million. Done? So that's how we were supposed to go with this. Done? I hope it's clear. Okay. So this is what we have overall speaking as far as for the questions are concerned. I hope you guys had a good understanding today about what we have done. Now, you must have seen one thing, or observed one thing over here, that overall speaking, the knowledge or the concepts is the older one. It's just that now we have shifted towards more explanation rather than the computation, right? So basically, we have to talk about what the standard has to say, what it has to offer, and what are the recognition criteria and all and everything, right? Now, the point which you have to do is just go through the questions which we have learned today, we have practiced today. Go through these questions again, read what I have written, check what is the solution which is provided in the exam kit, compare it with that, read the material again which you have, the source, and then try to redraft your answer in your words as well. Because you might have observed that as far as explanation was concerned, by following the basics for the standard, I tried to write it down in my own wording in the simplest form, that I could, right? So same is expected from you. Done? So this is what you have to do. You have to do the reading again. In the whole week, and then obviously in the next week when we are going to come, obviously we'll start off with the newer standard, and then we'll start off with that standard and explanation and all, right? So till we meet again on the same channel, same place, same time, it's time to say bye. So you have to take care of yourself, your family, your friends, and the people around you. Okay. And the WhatsApp group has been created. I've already shared the link for the Google Drive to download the books and the exam kits. So if you have any query or something, you are more than welcome to write me over there, or you can even ask me question, anything, if you have anything, over here as well. And then I'll be more than happy to assist you and guide you, right? Again, the secret, the more you read, the more you get, right? So start reading the books from now, start reading the accounting standards. Okay, Nathan, you're saying, okay, you want me to add you to the WhatsApp group. Nathan, do you have the coordinators? Basically, I don't have the admin controls for the WhatsApp group. Let me write the number of the coordinator for all of you. If somebody's not in the WhatsApp group, I can find the link in the WhatsApp group. Okay, Sandeep, maybe you might have been added later. Let me just, where's the number? Oh, how to see the number? Okay. How do here's the number. Okay. Here's the number. Plus 92 301 9191 500. Here we go. Okay. This is the coordinator's number. Nathan, you can please message on this number that you have not been added onto the WhatsApp group. So kindly please add you to the WhatsApp group of the SBR. Do mention my lecture and my batch number as well, because they are parallel, like number of batches which are been running, right? And then Sandeep, you couldn't find the link in the WhatsApp group. Okay, for the link. Okay. I'm sorry. I did not send you the link. Okay, my bad. My bad. I accept. Actually, I haven't shared the link over here in this batch. Okay, let me just find the link again. I will straight away send it to you guys, okay? Or if you can wait for a second. Give me a second. Let me just open up the Google Drive parallel. How about if I share you over here straight away? Okay, these are the SBR. Okay, I had it with me. I'm surprised. How come this is not shared? Let me just open it up. 1 second, just 1 second.